Part B, refer to the information under the heading Live Pty Limited. Discuss what the implications the information provided will have on the calculation of Live Pty Limited's tax liability. Make sure you see liability, not just taxable income, for the year of assessment, and you are required to provide calculations to support your discussion. Now, I'm not going to write out the whole discussion, but I'm definitely going to go through the calculation with you guys. Okay, so let's actually do it in that form. I'm going to do it in the form of a calculation because I think this is the best way of usually approaching it. I'm not saying do the calculation, but you'll do the calculation almost in your head. Okay, so the first thing is, so what we're going to do is we're going to go through this process where we say gross income less exempt income gives us income less deductions. Now remember, and for these exam purposes, it's not necessary to group all your gross income under gross income, or everything under exempt income, everything under deductions. Okay, and then that's our taxable income, and the tax is calculated at 28%, and we then do our section 6 squat will be deducted from there. Okay, so I'm going to go through the calculation in that way and do it, and that is what we will then discuss. Okay, so let's start. So the first thing is they received gross dividends, so that's before dividends tax, which is correct, of £25,000. So we would say foreign dividend, £25,000 times, and then what exchange rates do we use? Do we use average? Do we use spot? Can we choose? You have to use the spot rate because this is a company, and section 25D says you have to use the spot rate. The spot rate was 18.25 on that date. So 25,000 times 18.25, 456,250. Then we get a section 10B3 exemption. This is a company, so it's 456,250 times 8/28, which gives us 130,357. Now this is the only transaction they've given to us, and it asks us what is the implication of this on our taxable income, or sorry, our tax liability. So this is what the taxable income will be on that amount. Now that amount is subject to tax at 28%. So 325,893 times 25% gives us 91,250. Now that taxable income over there contains an amount, this 456,250, which has been subject to foreign tax. How much foreign tax? You'll recall from our discussion that usually it's 20%, but because of the double tax agreement, we have to use 15%. So that is the foreign tax that was paid, is 15% of that amount. Okay, so section 6 squat. Okay, section 6 squat is the lower of the foreign tax paid or the South African tax paid. Now, you would do that foreign tax calculation. Now, the foreign tax calculation is it's £25,000 times 15%, because this is the gross dividend, 15% of dividends tax rate, times what exchange rate? Here we have to use the average exchange rate of 18 rands. That is a requirement of section 6 squat. Right, you can go and see that in section 6 quat 4. So you have to translate it 18 rands. That gives us 67,500. So our section 6 quad rebate is the lower of 67,500 or 91,250. Okay, so which is the lower of the two? The 67,500, so that's what you would select, right? That amount, I'm just doing it like this, gets deducted from that 91250, and whatever the amount is, that is your tax liability. So what would you discuss now? You would discuss the fact that this gets included in gross income. You would discuss that it gets translated at the spot rate in terms of Section 25D. You would discuss that you get Section 828, the rebate. You would discuss that the tax is calculated at 28%. You would then discuss that Section 6 quad is there because these amounts are subject to foreign tax. You would then discuss how the foreign tax is calculated, talking about the average exchange rate. You would then say what Section 6 quad says is the lower of these two amounts, and you would apply it. And that is really how a discussion question gets put together most of the time, especially when it talks about calculations like that. So that is 12 marks available, an easy-ish 10 marks to score. Okay, what is next? Next is number C, or part C, which says refer to the information under La Rata Boyane. Discuss whether La Rata can claim expenditure in respect of a home office. And your answer should give clear reference to the requirements of the Act and clearly state what your concerns are. Okay, so we already basically discussed this. Section 23B says that you're not allowed to deduct home office expense. However, you are allowed to deduct it if it is specifically equipped for your work, it is regularly and exclusively used as an home office, and if you earn a salary, which she does, your duties must be mainly performed there, and so it must be a requirement of your office. In this case, it's not regularly and exclusively equipped, and she only works there after hours, so therefore she cannot claim Section 23B. And then D, refer to the information under Jamil Khan. Discuss the nation's tax implications that you should be aware of in respect of the transactions discussed. Your answer should include reference to the Act and or adequate explanations. Okay, so what happened to Jamil here? So Jamil is the guy who created the trust a few years ago, and he donated some assets. But in the current year, what happened is he gave an interest-free loan on the 1st of September, which is then subject to Section 7C. Section 7C says there's a deemed donation, which is calculated as the loan times the official interest rate less the actual interest charged times the number of days over 365 or 366, depending on if it's a leap year or not. So that's what Section 7C says. So you'll discuss that. The official interest rate here is calculated as 7% plus 1%, so 8%. There's a mark for that, mark for discussing these things. The fact that there's no interest charged. Then Section 7C says, when does it apply? It applies if there's a loan to a trust, you are connected persons, then you basically do that calculation that we talk about. Right, so there's a loan, there's a trust. Is he a connected person? His beneficiaries are connected persons to the trust. The beneficiaries I'm talking about are his wife, son, and mother. Because they are family members, he's connected to them. So he's connected to their connected persons. So therefore, he is a connected person. Right, so this will be September to February, the amount, and it's treated as if it's on the last day of the tax year, which is 28 or 29 February, depending on if it's a leap year or not. Okay? Let's see. So that's what you would discuss, but you would also discuss the fact that the vehicle here was on the 15th of December. So it takes place, the vehicle goes first, then Section 7C. Jamil would also have to calculate the nation's tax on this vehicle. Because this is the first one, he can deduct the 100,000 rands annual exclusion against that. The annual exclusion is in Section 56(2)(b), the nation's tax. If there's anything left of that 100,000, he can deduct it against whatever this donation is deemed to be under Section 7C. Right, and then the nation's tax must be paid by the end of the next month. So if this is in 15 December, the donations tax on that must be paid by 31 Jan. And if this one is on the last day of February, it must be paid by the 31st of March. Okay, so let's just go and see it here also. Just this, the official rate of interest calculation. Why will Section 7C apply? How is it calculated? From what period? When is it payable? Talking about the car being donated. There's donations tax on that as well. You can use the 100,000 annual exemption. Donations tax calculated at 20%. Unless his donations have exceeded 30 million in the past, then it's 25%, payable at the end of the next month, and he is liable for it. Right, so 10 available, 7 marks max. And that's it, guys. I hope you enjoyed this question. It is a challenging one because there's so much discussion, but I wanted you guys to remind you that it is very possible for them to ask it. I hope it went okay for you guys with this, and that you enjoyed it. Good luck with the next one.